Welcome to Hidden Empires, the channel that uncovers the untold stories of self-made billionaires. From toy sellers to tech visionaries, from forgotten failures to global empires, we reveal the strategies, risks, and turning points that built fortunes.
They say no man is an island, but some investors are. Take our investor today. He's a believer in the power of one. And this is how he beat the market. Our investor today is Rajiv Jain. He grew up in India, earned his MBA, and began his career managing emerging market funds. While other managers chased short-term wins, Rajiv studied businesses like a biographer. He looked for leaders with integrity and long-term strategies. This meant he wasn't interested in betting on short-term trends or fads, nor was he interested in copying what other investors were doing. Instead, he sought companies that he understood deeply and that he believed had durable competitive advantages. But this approach didn't make him popular. It made him a lot of enemies. In fact, it nearly cost him everything he had built. Let me explain. In the late 1990s, Rajiv worked at a Swiss bank called Vontobel Asset Management. There he managed a fund called the Vontobel Emerging Markets Equity Fund. It was doing quite well. In 1994, the fund returned 38%. In 1995, it returned 40%. Then came 1997 and the Asian financial crisis. Many of Rajiv's holdings, companies that he had carefully studied and invested in for the long term, suddenly tanked. Investors panicked. They pulled out billions of dollars from the fund. For 3 years straight, the fund lost money. In 1998, it lost 12%. In 1999, it lost another 6%. In 2000, it lost 15%. That was more than most investors could stomach. They demanded that Rajiv change his ways. They wanted him to play it safe, to stop investing in individual companies, and instead mirror the index. In other words, they wanted him to become an index fund manager. But Rajiv refused. He knew that what he was doing was right, so he held his ground. Slowly but surely, the situation stabilized. The fund recovered, but the experience shook him. He realized that even if he was right, if his clients couldn't see the light at the end of the tunnel, they would never give him another chance. So in 2001, he did the unthinkable. He closed his fund to new investors. To those who were already invested, he promised to do everything he could to make them whole. But he told them that they might have to wait a while to get their money back. Then he did something very uncharacteristic. He started buying back into the market. He began investing in individual stocks once again. But this time, he was more cautious. He knew that even if he was right about a company, if its stock price kept falling, investors would lose faith. So this time he decided to only invest in companies that met two criteria. One, he had to understand them completely. And two, they had to be fundamentally sound. He only wanted companies that were run by honest, competent management teams. He wanted companies with strong balance sheets and cash flows. In other words, he wanted what Warren Buffett called a moat and a castle. Well, naturally, this meant that his portfolio would have far fewer stocks, but Rajiv was okay with that. In fact, he preferred it that way. He explained, the more concentrated you are, the less likely you are to be influenced by what everybody else is doing. It took a while, but eventually the markets rewarded his patience and his discipline. Between 2009 and 2016, his fund outperformed 99% of its peers. But he never rested on his laurels. He continued to stick to his principles. In 2016, he decided to leave Vontobel and start his own firm, GQG Partners. Today, GQG manages over $100 billion in assets. It's one of the fastest-growing investment firms in the world. And Rajiv's funds have continued to outperform. In the past decade, his best fund has returned nearly 16% annually. At the same time, he's avoided much of the herd mentality of Wall Street. He's made contrarian bets that others have shied away from. For example, He was one of the first investors to buy fossil fuel companies. When everybody else was going green, when ESG trends had scared off other buyers, when everybody thought these companies were doomed, Rajiv saw an opportunity, and he bet big. Today, according to the data provider Refinitiv, GQG Partners is the biggest owner of ExxonMobil among funds based in the United States. All of this has made Rajiv a billionaire. But he hasn't stopped. He's still looking for those special companies, those few and the mighty, as he calls them, those companies with a durable competitive advantage and competent management. Because, as he's learned from experience, they may not always be in fashion, but they always deliver. And that's a good reminder for all of us. Following the crowd may keep you comfortable, but it rarely makes you exceptional. Find your principles and stick to them, especially when they're unpopular. Be like Rajiv. Be an investor.
We hope that you enjoyed this episode. Please subscribe, like, and comment so others might find and enjoy these videos. Go to description below for more resources and information. Thanks for your time.